This is not a financial advice. Information provided is for educational or entertainment purposes only, and not personalized financial, investment, or legal advice. We explicitly stated that the content is not a professional advice, and no fiduciary relationship or no advisor-client relationship is created. We also would like to remind you that investing involves risk, including potential loss of principal. We strongly advise seeking a licensed professional before acting any investment decision.
Predicting the price of gold toward 2030 involves analyzing structural shifts in the global economy, monetary policy trends, and geopolitical instability. While long-term forecasts vary significantly, many experts believe the convergence of debt levels and currency devaluation could drive gold to unprecedented highs. Key drivers for gold through 2030. 1. Monetary devaluation and the beautiful deleveraging. Ray Dalio, founder of Bridgewater Associates, argues that the global economy is in a phase where countries must print money to manage massive debt-to-GDP ratios. This debt monetization process typically devalues fiat currencies relative to hard assets like gold. 2. Central bank demand and geopolitics. There is a growing trend of central banks, particularly in BRIC nations, Brazil, Russia, India, China, diversifying away from the US dollar. If these emerging markets increase their gold holdings to match the gold to GDP ratios of Western nations, it would require thousands of tons of additional demand, exceeding annual global production. 3. Inflation versus mean reversion. While some analysts view gold as the ultimate inflation hedge, others, such as Claude Erb and Campbell Harvey, caution that the real price of gold, adjusted for inflation, is currently high by historical standards. Their research suggests that if gold follows its 2,000-year history of mean reversion, the real price could theoretically drop back toward $800 in a non-inflationary environment. 4. Supply constraints. The In Gold We Trust report highlights that despite record prices, gold production has not significantly increased over the past decade. The 10 to 15-year lead time required to develop a new mine means that supply is likely to remain inelastic through 2030, supporting higher prices if demand remains steady. Expert forecasts and perspective for gold prices in 2030. Goldman Sachs. Analysts have recently shifted their view to a more bullish stance, citing that central banks are buying gold at record rates as a hedge against geopolitical risk and U.S. sanctions. These industry veterans like Rick Rule and Sprott often point to the proprietary valuation model used in the In Gold We Trust report, which predicts $4,800 as a baseline by 2030, potentially reaching $8,900 if inflation remains persistent. Stoufferle and Valek, 2020. While not a price-specific forecaster, McKinsey notes that the future of wealth through 2030 depends on whether economic growth can catch up with the global balance sheet. If productivity fails, real estate and equity values could drop by 30%, making gold a more attractive safe haven. JP Morgan has modeled a bullish 2030 projection of $8,000, citing a permanent recalibration of reserve assets. Their base case sits closer to $5,500. UBS and Goldman Sachs, both banks have recently raised their midterm targets. While they typically forecast only 12 to 24 months out, their trajectory points toward a $5,000 plus environment by the end of the decade, as fiscal instability persists. The renowned economist Charlie Morris predicts $7,370 by 2030. His math is based on a decade of 4% average inflation and gold returning to its 2011 real value ratio. Jim Rickards, author of The New Case for Gold, Rickards argues for a math-based target of $15,000 plus. He calculates this by dividing the global M1 money supply by the amount of official gold, suggesting this is the price required to back the financial system in a crisis. Robert Kiyosaki, the Rich Dad Poor Dad author, has frequently teased a $27,000 target. While seen as extreme, his logic follows a crash of the century scenario, where fiat money loses all credibility and gold becomes the primary global medium of exchange. As reasonable forecasts based on current trend, the gold price shall be ranging from 5,500 to 8,000 range in 2030.
If you like the information given in this video, please do not forget to like and subscribe. We will try our very best to dig up information for gold, ETF, and cryptocurrency forecast. Thank you.